my pleasure to welcome you to this fantastic event hosted by Optiver, where today we're going to focus on really the role of financial markets in the green transition. My name is Victor van Hoorn. I'm the Executive Director of the European Sustainable Investment Forum, a trade association bringing together responsible investors. And today I'll be acting as your moderator. So maybe I'll just walk you through a few of the housekeeping rules today so it's clear for everyone. That event will be recorded and will be made available later on to participants. The second thing is, so it's not on the Chatham House. And if I want to pay particular attention afterwards, later on when we will have a Q&A session, people will be able to, through the Q&A function, to ask a question. When you do so, please state your name and the organization you represent, and afterwards you'll have the opportunity during the Q&A session to be promoted and switch on your camera so that you can ask the question live. So be ready for that. But before continuing, I'd like to hand over the floor to Jan Bomers, CEO of Optiver, who's acting as our gracious host facilitating the discussion today.
Well, Victor, thank you for the introduction and welcome to everybody on behalf of Optiver on what we think is a very exciting topic for us to address, financial markets and the green transition. It's good to bring all of you together, especially with the impressive list of speakers we have, to start a discussion on how we can all fulfill our role in this transition towards a greener environment. This year's development, especially given COVID-19, has painfully made clear that it's time to all work together, no matter where we are, to create a more sustainable environment and a more sustainable society. We believe that the Green Deal, and more specifically, the chapter where we can make most impact, being sustainable finance, will be a crucial step of the many we have to take. Ultimately, history will judge us by our actions. And I'm honored to host an online discussion on how the capital markets can fulfill this important role in the green transition. I would like to introduce the speakers. First, Caroline Nachtegaal, Member of European Parliament. Caroline is the leading Dutch voice on security capital markets issues in the European Parliament. This week, for example, she successfully concluded a deal as lead negotiator for the European Parliament on BMR. She has been an MEP since 2017, and in addition to being a leading voice on market issues, she's also heavily involved in transport issues, where she pushes a sustainable agenda to green EU transports. Before joining the European Parliament, Caroline held the position of chairman for the local VVD Rotterdam network for over 2 years. Thank you for joining us. Tania Panova, head of the CMU unit at DG FISMA European Commission, is also joining us here. Tania has been serving as the head of the CMU unit in the Commission since 2018. She recently delivered the Commission's action plan called Rebooting the EU CMU Project, which outlines the Commission's key priorities and expected initiatives on capital markets through 2023. It is viewed as a key initiative to provide the funding necessary to deliver the European Green Deal. And by the way, we talk about a lot of money here. Prior to that, Tania headed another unit in DG FISMA and served in the cabinet of Vice President Valdis Dombrovskis, where she was responsible for CMU, securities markets, asset management, insurance and competition. Thank you for joining us, Tania. We also have David Harris, Head of Sustainable Business at the London Stock Exchange Group. David has been serving as the Head of Sustainable Business at the London Stock Exchange Group since 2016, as well as the Head of Sustainable Investment at FTSE Russell since 2002. Responsible for global engagements on sustainable investments for FTSE Russell. Other various industry positions include member of the European Commission's high-level expert group on sustainable finance, Vice Chair of UK SIF, serving on advisory committees for the UN, City of London's Green Financial Initiative, and he chaired also the UN Sustainable Stock Exchange work to develop model ESG reporting guidance. My God, if there's an expert, it has to be David. And we're lucky to have Victor to moderate. Maybe a few words on behalf of the whole of Optiver. We will reflect on how each part of the capital markets ecosystem can play its role in this transition. As you know, we are a global market maker with a history of almost 35 years in capital markets. We at Optiver are committed to fulfilling our role in society at large, including the green transition. And I have to say that has come natural to Optiver from day one. For us, environmental, social and governance considerations are fully integrated in our operations and decision making. We view it as a way of doing business every day. We take a holistic approach to this. We consider our operations and our core business as the key elements in our ESG strategy. This strategy started with an assessment of where we stand as a company. What is our footprint? How diverse are we as a company? These and others are all questions that we believe are important when managing a business that is fit for the future. The assessment has made clear that we are already doing a lot. But you know what? More to be done, much more to be done. On the operational side, we are committed to further limit our environmental footprint and offsetting our carbon footprint by 200% through reforesting projects globally. Very interesting project, by the way. Highly recommend you looking into it. Next, and more importantly, we aim to fulfill our role in the green transition through our core business, providing liquidity. At the moment, we provide liquidity as market makers in over 100 ESG instruments. This varies from ETFs, futures and options. Providing liquidity, we believe, plays a fundamental role in creating a deep and liquid ESG market. This in turn enables a shift towards sustainable investments, as it will make it more attractive and cheaper for the end investor to reorient their capital towards sustainable investments. Secondly, and more specifically, as investments in environmental and social objectives require a long-term orientation, providing liquidity in derivatives enables investors to hedge their positions, which is crucial for the management of long-term sustainable investments. This again contributes to long-termism. And thirdly, by providing a tight bid-ask spread, climate change-related financial risks can be hedged with minimal costs. This contribution to enabling and mainstreaming the management of financial risk comes from climate change. What is most important right now is for everyone to take a step in the right direction, we believe. To determine the right direction and the path to sustainable finance, we hope that discussions like these about how to approach it can help everyone take a step in the right direction. In today's discussion, we will hear different voices and whether the current capital market structure is fit for purpose and what role capital market infrastructure providers in particular should play. I'm looking forward to the discussion. We might have some controversial statements left, right and center. That's what it's all about. Handing over to Victor. Good luck.
Thank you very much, John. So I guess this afternoon, the first theme as a moderator I'd like to explore is, whether the current capital market structure is actually fit for contributing to the green transition. And so maybe, Caroline, if I can turn to you first, as Jan said, you're a prominent member of the European Parliament Econ Committee. You've been there for a long time. I think you're one of the most authoritative members in that committee. So maybe you can share for our benefit a bit, what is the expectation that politicians, policymakers have for financial markets, and how can they contribute?
Yes, thank you, Victor, and good afternoon to everyone. And maybe let's start by saying that I'm happy that you organized this webinar, because this is a topic I like to speak about, because when you are a member of the Econ Committee, to be honest, these are difficult times. Jan mentioned it, but also regarding the crisis. But when you look at the topics and the files we are dealing in the Econ Committee, and when you are a Liberal member for the Netherlands, you are on most of the topics regarding the recovery fund, regarding own resources, NPLs. We are always a bit reluctant, let's say conservative, a bit concerned. Well, you can, as liberal, I will call it realistic, but talking about especially this subject, sustainable finance, the sustainable transition, that's in my opinion the way forward. That's a positive way of talking together with the market. So I'm always happy to take part in panels like this, especially also when the market is available as well. Because sustainable finance is growing very, very fast. There was an increased interest by the market operators and policymakers, and that has also caused the creation, in my opinion, of the market initiatives and a regulatory framework worldwide. So when you ask me what are the expectations of policymakers in this system, I think when you also look to the report from the high level expert group, especially focused on the sustainable finance, I think that we can see that, and it outlined that the financial market, the whole ecosystem, can play such an important role in the whole green transition, and by doing it via, well, green financing, but the other part is the greening finance. So these are two elements, and I see David nodding, these are very relevant in my opinion. First of all, the green financing is challenging private capitals to green investment and green transition investment. And greening finance, yeah, well, that includes, in my opinion, the climate, environmental risks into decision making. So I think, and that I would like to conclude, that as policymakers, we are building up the regulatory and also the supervisory framework to facilitate these trends.
Okay, well, thank you very much for this very encouraging words. Maybe Tanya, if I can turn to you now. As Jan said, you're essentially the head of unit in the Commission in charge of leading the Capital Markets Union policy agenda. You're really leading that effort. So I guess my question would be, how important is this Capital Markets Union agenda for delivering the Green Deal? What are the synergies between the two? And maybe building on that, what role do you see for equity capital markets and debt capital markets in that space?
Thank you very much, Victor, for the question, and very happy to be here today. Well, it probably will sound a bit banal, but yes, CMU is essential to ensure that there is enough private investment into green objectives. I know, Jan, you were quoting bits and pieces from the Optiver's paper. I've read it now too, and I saw you quoted, I think, somewhat higher than 200 billion per annum necessary in terms of private investment in order to support the objectives of the 40% reduction by 2030. Now, according to our figures, actually, I've checked those figures, our figures are much higher. According to our estimates, we need more than 460 billion euros per annum to finance this transition. And if we also consider what our president said in September during her State of the Union speech, when she actually decided to even be more ambitious on the Green Deal, and suggested not a 40% objective, but a 55% reduction objective, that would require additional 350 billion annually, which means we're approaching closely €1 trillion necessary per year in order to finance the green transition. Of course, public money will remain to be very important. Public support will remain to be very important. But okay, we should understand also the circumstances we're in. Today, the main focus is really on COVID and companies and saving companies from what lockdowns across Europe entailed for everyone. And I think the green objectives, I wouldn't say become secondary to that, but in a way, everything is relative. And I think growth and green growth sometimes are seen almost as synonyms, but not entirely. So I think public money only is good as there is available public money, but I think we need to think broader, and the availability of private investment and adequate products that would channel this private investments would be paramount to find this 1 trillion euro that we need. Victor, you asked a question about debt and equity. So I think that what we need ultimately is relevant company information that would allow us to label the debt and equity products as truly green products. Because what we need to avoid, because currently there's a lot of green trends, I think, in Europe, and that's all understandable. People get excited about green stuff. And Caroline just now spoke about, how important it is to capital markets, to attracting also people to capital markets, and we see a lot of potential also to increase retail investor participation in capital markets precisely by those ESG products. But is everything truly green? In order to make sure that only truly green is called green, we need actually information, company data that would allow to see that truly green companies and truly green projects actually get noticed by investors, including retail investors. And for that, we need information that companies report on this information. That's where the taxonomy comes in. But I'm sure we will talk more about this in a second.
Okay, thank you very much, David. I think I've seen you profusely nodding in support of what two first speakers have said. So obviously, feel free to jump in and comment on that. But I guess you're coming at a perspective from really a large group that has a multiple hats on when it comes to being present in financial markets through infrastructure. I guess I'm curious for your perspective on seeing where the market is currently, where we are, whether the infrastructure is promoting those products rightly, and what can be improved. So. And before you start, if I can just remind the audience, feel free to ask questions at any time. We'll pick up on those at the end of the session. Well, over to you, David.
Thanks, Victor, and thanks Optiver for organising this event. I feel very honoured to be with such esteemed other panelists. Maybe it's worth, just by way of context, just explaining a little bit about the group. So we've got, on one hand, we have the capital markets part of the business, which is where the exchanges are. We also have the information services part, which is where FTSE Russell, the kind of the global benchmark provider, is part of. We also have the post-trade business, which, for example, LCH ClearNet is part of. So we've got these three different parts of kind of capital markets infrastructure, and sustainable investment and finance is deeply relevant across all of it. I think it also gives us a different perspective. So on one hand, through the exchange part, we're very close to the issuers and understanding where they're coming from and what they and how we need to try and support them on this agenda. But also then particularly through the information services, working very closely with investors, particularly asset owners, who really have been driving this agenda, to help try and support them in what they're trying to achieve. So in a range of areas, including like on disclosure, I think we've got quite an important role to try and play between kind of trying to bridge some of these different pieces. I think the vision from the EU here has been fantastic, and it was wonderful being part of the high-level expert group. And I think that really did provide an excellent blueprint for action. And the ambition level in terms of the Sustainable Finance Action Plan and moving that forward has been incredible. But we also see that markets shifting around the world. We see, obviously, the UK's been coming up with a number of important announcements very recently. China's clearly moving on this agenda. Canada's moving on this agenda. Other Asian markets outside of China are as well. And there is also, and that's, a lot of the things are fantastic, but we do also need to make sure this stuff is joined up. And we need to make sure that we're getting a kind of a global consistency. There can be differences, but there needs to be an interoperability to kind of support this. But linking into what the other panelists said, and I think also maybe a bit about our role too, is this disclosure piece, and that is that we need to unleash the power of capital markets to address sustainability issues, and that can work very effectively. But one of the key pieces is we need good information. We need decision relevant data and information which investors can be used to orientate capital. And there are significant gaps in that today. We also obviously need all the real economy pieces that make sure that external costs are internalized, that you're getting suitable carbon pricing, that getting the right efficiency standards. But there are barriers in the place which stops capital markets being as effective as they can be. And a lot of what the Sustainable Finance Action Plan has been about is addressing some of those barriers and trying to make sure we're getting, also really important, getting data flow through the system. But I should say it's important to be aware that investors are not waiting for that data to become available. They're getting on with it. And this is, as I said, being driven particularly by the asset owners, the pension funds and the sovereign wealth funds. They have really, I heard what's been said on retail investors, and I think it's really important to engage them both in terms of directly, but also through engaging their pension funds. But what's really positive is particularly the larger pension funds, the public pension funds are taking action. They are moving their assets. Initially, that impacted active funds. Over the last 4 or 5 years, increasingly index funds and passive funds as well. The market here is shifting, but it could shift faster and more efficiently and better where we have better information flows through the entire system.
Okay, thank you very much, David, for those thoughts. Maybe turning to Jan and building further on that theme of markets. Jan, as Optiver, obviously your company, Optiver, you're trading every day on a lot of markets, so you have a very, I think, good picture, probably better picture than most of us about what's actually going on these markets. And we've seen a lot of ESG products emerge. How do you see those products currently in their ability to reorient capital flows towards material ESG issues?
Sure, and I think as David laid out very nicely, is there are many components to the market structure, all have a role to play. From the data vendors to the exchanges to the end investors. We as market maker play a small role in that, and we clearly we operate on the infrastructure provided to us by parties like the LSE. But with most new products, we feel that the buildup of volume takes time, and the whole concept of ESG products and the derivatives on those products has gained a lot of momentum. But at the same time, people have to kind of come to a consensus view on what products are most relevant for the various investment policies they might have. Therefore, we at Optiver, when we talk to issuers in particular, we say, okay, let's keep it as simple as possible, especially in the beginning. Let's not overcomplicate the products, because before you got too many products, all complicated, and nobody knows what to go for. Too much confusion. So our strategy there has been, okay, let's work with the issuers, let's work with the market infrastructure providers, let's work with the exchanges and say, okay, let's make sure that the products which come to the market have their potential interest. How can you provide liquidity on those products? Because that in itself is a challenge. And make sure that the end investors appreciate what the product stands for, both the product and the derivatives on those products. And secondly, you really have to find a balance between a standard product and a specialized product. We think that if you start in a new market, you want to start with certain standards. Like you have certain futures that represent the US market or the European market or the Chinese market. We should have the same for ESG products, both local and globally. So standardization versus specialization, and specialization we feel of products should come later in the process. And then, the long-term view has to be that ESG products become the standard for the capital markets. Yeah, and we're going to talk about that a bit later, but we do feel that by having a few standard products and even fewer specialized products, you create a momentum. There is going to be the demand, the liquidity, and the visibility in the marketplace. And then, it becomes like that flywheel, which generate more interest. That's what we focused on. And the only thing we can do as a market maker is provide the liquidity and work closely with all the participants in the market structure.
Okay, thank you. David, I saw you nodding. Do you want to come in and comment on Jan's comments or echo that? Is that something you see as well?
I mean, to the point that, this is, back when I joined FTSE in 2002, this was a niche area. There was a small number of ethical retail funds who were interested in ESG indexes, but at that time pension funds were not really involved. Now, this is the majority of times we see institutional investors, certainly within Europe, switch benchmarks. They're switching because of climate predominantly, sometimes other ESG aspects. We did a survey globally of about 140 asset owners, and 72% said that they were either already integrating ESG or climate into their benchmarks or looking to do so. Now in Europe, that was 85%, but even in the US, it was 63%. This is a global phenomena. This has moved from being a niche part of the market to the norm, the market norm. There will be different approaches. We do need more standardization. There's a number of efforts underway to do that. And we do need international collaboration here. So what's very important is things like the International Platform for Sustainable Finance that the EU set up with China, the other markets including Japan, I think the UK now are joining as well. It's so important. We need to have, we need to get policymakers working together. We need to get the right level of market engagement in that as well. Both corporate issuers and investors. And by investors also, it's particularly because we have to recognize it's the asset owners which have been driving this. And often their voices sometimes are rather more absent than the asset managers. And ultimately, at both ends of the investment chain, you've got interests which are actually quite long-term in nature. The asset owners are interested in very long-term, stable, sustainable. How can they help drive sustainability? How can they help drive long-term sustainable outcomes and more market stability? And some refer to themselves as being intragenerational investors. GPIF, the biggest pension fund in the world, talks about this. And how can they incentivize the whole marketplace around sustainability? Because their investment beliefs is higher sustainability means higher standards. And on the other side, with corporate issuers who also want to focus on long-term strategic issues, less about the kind of the noise of short-term results. So this requires a lot of collaboration across all parts of the market and globally between different policy players. But I very much agree with Jan about the need for standardization within that.
Thanks, David, for those comments. And I think I'll allow myself to make a comment as well. I think the EU can be very proud of what it has achieved in that space already. If you look recent weeks, other parts of the world like Australia and New Zealand have launched their own action plans, which have an uncanny similarity with what the EU did previously in its action plans. So I think it's really an area of European leadership. I think, Caroline, if I may turn to you on the European leadership, and we've heard about the capital markets and indexes and the importance for standardization. I think you, as Jan said, you've played an important role on the benchmarks regulation. We've obviously, the EU's moved forwards with a number of specific benchmarks looking at the ESG space. I was wondering if, for our audience, you can tell us a little bit more about, what's the further thinking in the European Parliament on that.
Yes, thank you. Well, let me first I would like to react on the comment
Sure.
made about the small role Optiver plays in this whole green transition, because I think then he underestimated a little bit the role they have. Because when you look Optiver and this kind of organizations, what you see that they're not only try, let's say, to limit their environmental impact by recycling initiatives, but also the offset for the carbon footprint. I know Optiver is by 200%. So that express how important, and in my opinion, how big the role could be of parties like this, and to be able to, well, say, successfully provide the liquidity, they need to be able to add the value to the market. And I hope that the market realize that market presence give well, let's say the privilege of experiencing of the critical things, the potentials of such a transition, but give also a huge responsibility to drive correctly your market practice through this transition. And I think the market expressed this in a great way. So in that way, compliments for them. And well, your question also about, well, let's say the benchmark part. Yeah, I'm very happy with the deal. It's not fully agree, but well, we expect to finalize it hopefully in the coming months regarding the BMR review. So that's, yeah, hopefully a good success, especially for the market. But well, when you look to the financial benchmarks, they help, of course, investors to create more investment products. So measuring their performance and devising also the asset allocation strategy, as well as the derivative market. So that helps to make the global economy manage their risk. That's especially the way they are doing. So what you see that you have two categories of sustainable benchmark. They are recently so introduced by the EU regulation, and they could be used, in my opinion, to create equity index future contracts tied to the EU climate transition benchmarks or the EU Paris alignment benchmark. And I think that helps how we can develop this. So, and let's finish to say that, and I think we should notice that as well, that the two categories of the benchmark introduced recently, they cover only a very specific part of the environmental issues and not the whole entire climate change spectrum. And I think Tanya is well more in depth know about this issue as well. But I think we have to keep it in mind as well.
Tanya, did you want to comment on that?
I actually have a few comments to make, so
Sure, go ahead.
Start with a few comments and then I get back to the comment by Caroline. Well, first of all, I wanted to talk more a bit, about the CMU and the role CMU would play in the whole thing, because, and I think David spoke to that in his intervention. We do need integrated markets. We do need deep and liquid markets in order to make sure that we channel things effectively. In order to make sure that products are sufficiently accessible, that the costs associated with trading of those products are not exorbitant, that people simply cannot afford. And here we're talking also about retail investor participation, so not just about big institutional investors like pension funds or insurance companies. So we need to create conditions that everyone can actually chip in, because there is a huge potential that, and that's why one of the objectives of the CMU action plan is really to focus on retail investment participation. There is a huge potential, huge savings that are, and I keep saying that, sitting, okay, perhaps not entirely idly on saving accounts, because banks do things with their savings. So I think it wouldn't be fair to say that they're completely sitting idly, but they're not being used in the same way, compared to how they could have been used if there were immediately useful market-based instrument financing. And there are ways, and I think retail investors are gradually waking up to those products. And this is also a way for us to raise financial literacy, because by being interested in ESG products, actually become interested in capital markets altogether. And then we can also, as a byproduct, solve a number of other issues that would come with it, or that we already have in Europe that we haven't found a solution to, like, for example, aging problem and the fact that people simply don't have enough retirement income for old age. So all of this actually is very much interrelated, and having, well-running interconnected infrastructures is essential to that, as well as is having adequately regulated products and services and adequate disclosures. Also those disclosures that can be understood, because I think one of the problem is we need to have disclosures that can be read and understood. And okay, sometimes we do have experts, and other times we have less experts, and we also need to encourage direct participation by retail investors in those products. Intermediation is good, and I'm very much in support of intermediation, particularly for more complex products. But we also need to support direct retail investor participation. Therefore, emphasis on disclosures is going to be very, very important. I think both Jan and David and Caroline mentioned leadership, and the fact that the EU has proven that we basically came in first. And David, you were talking about back to times when you started in LSE, and how little attention ESG stuff was receiving those days. And I can tell you also, judging by how much resistance also internally within the Commission, those things were receiving several years ago. And currently, everyone would like to talk about green. Everyone wants to do green. We want to do green everywhere, including as part of our, recovery and resilience facility, because people realize that we can make a difference and that people do care. And I think politicians realize that people do care. And I think as politicians, have an obligation, basically. But I'm not going to speak. I'm sure Caroline would have something to say there. But we also, as policymakers or those who propose legislative acts, we need to listen to the voice of the citizens, what citizens want, and citizens want green. So we need to make sure that we reflect in our policies green stuff, and we need to make sure that we retain our leadership, because it's one thing to establish leadership, but it's quite another thing to maintain this leadership. And I think by having different standards everywhere, the risk is that this leadership can be diluted. So that's why I think we consistently promote the use of taxonomy, which is a first of its kind in the area of really very detailed, very scientific approach to determining what is green and what is not green. I'm not going to ask you all to read the 500-page document that has been published on the climate mitigation. There will be many more to come next year, including on the one that will actually specify precisely what companies need to report in order to demonstrate their alignment with the taxonomy. So all of these things will come, and of course with this comes complexity, and companies, because there are two sides to everything, companies would like to have investment, but they also complain sometimes that with this comes a lot of disclosure requirements, additional disclosure requirements. They need to do a lot of assessment themselves that they previously didn't do. And of course, that leads to a certain burden for these companies. And some of these companies are willing to assume this burden and do these things. But for others, it could mean something that would potentially be fairly costly to them, and a price to pay for them being more visible, attractive, and that's something that is relevant as well. And maybe a last remark on the need to be dynamic, because okay, it's a snapshot, okay, of what the situation looks today. The taxonomy is good, but it's good as long as, you know, the economy stays the way it is and, you know, market activities the way they are. But what is essential is to make sure that the taxonomy does not become a stale bread, that it's something that, you know, keeps changing and developing in line with the economy, global economy. If we want taxonomy to be a global standard, we also need to make sure that it reflects the way the global economy develops. So this is maybe a few remarks that I would like to make. And on the points of you know, the benchmarks and the Delegate Act that deals only with one element, and the benchmarks that, okay, also very, you know, the two ESG benchmarks that have been I think put forward and agreed, they relate only to two very specific you know, ways to basically either reference performance or create you know, linked products based on those benchmarks with very specific methodology. But of course there could be different products, and I think what is important is to not to put you know, a straight jacket on something that is just developing in a nascent form. So this is an important consideration as well.
Thank you, Tanya. I think one of the interesting points you mentioned, and I'd like to build as a segue here, maybe to ask a question to David here. We've heard from Tanya that it's very important to strike the right balance between disclosure and not overburdening companies, you know, making sure that there's the right information disclosed. Of course, you as LSE Group, you have an interesting position that because you sit on the one hand between the issuers that are listing on your markets, you also talk a lot to the users of your markets, investors. So I guess my question would be, what role can trading venues like yours play in ensuring that increased transparency, which ultimately transparency is what markets drive, what drives markets, what makes them function. So your thoughts maybe here.
Thanks, Victor. Maybe, yes, let me cover that, but also use that maybe as a segue onto the benchmarks piece as well.
Sure.
So, let's start off with disclosure then, and the role, as you say, of exchanges and organisations such as ourselves in supporting that. To make, as I said, to make all of this work, we need to get the data right. This is foundational for everything else, for the climate benchmarks, obviously for the you know, the sustainability reporting for financial institutions and around portfolios. You've got to get the underlying data right. It's got to feed through the whole system. So, and it needs to be consistent across it all. So how do we get that data flowing? Well, you know, we do need the right kinds of regulations, and we need regulators working together. I think, you know, getting IOSCO involved here is going to be important, and you know, the current consultation by IFRS, I think, is very important here as well. I think for you know, if we take particular focus on climate, you know, here we've got three key things coming together. We've just got the sheer urgency, the societal urgency to get on track fast. There's urgency around a lot of sustainability issues, and which is big, but climate is, I guess, probably still right at the top of the pile. You've then got this is an area where we've already got good global consensus through the Financial Stability Board and the Task Force for Climate-Related Financial Disclosure, TCFD. We've got a basis. Some of it, is not super specific, but it has got quite a lot of quite specific elements within TCFD. But that gives a good basis for action. And this is then thirdly, this is an area where investors are allocating today and need this data. So for all three reasons, that needs to be pushed forward. Now, roles of organisations like exchanges, I think, here is important. We can be working together to try and push this, to be able to bridge issues on our markets and to support them in terms of providing the kinds of data and information that investors need. We kicked off an initiative with our Chief Executive, David Schwimmer, wrote a letter with Mark Carney to the CEOs of exchanges globally to say, please work with us on common climate reporting guidance. And then under the UN Sustainable Stock Exchange Initiative, Jan Kleidi mentioned the work they'd done previously on ESG reporting. The next stage is And I should say, for that ESG reporting guidance was quite principle based. It was, what are the principles for high quality reporting? But we weren't specific on the individual metrics and data points a company should be reporting on because of the plethora of standards. But on climate, we can be much more specific because of TCFD. So we've already had one meeting of a number of the exchanges all coming together. With the idea is that by June we come up with model guidance. It's not trying to come up with something new. It's basing it on particularly TCFD, but also actually things like taxonomies. TCFD has one of the indicators is low carbon products and services, but it provides no definition set for that. Actually, the taxonomy work is a great way of plugging in to that aspect of TCFD. So we can maybe draw those points, get the exchanges to be consistent in this, and then we can all. This provides the basis for guidance on good practice reporting, and also the basis hopefully training and support that exchanges can provide. And I think it's very powerful for exchanges to each talk to their respective markets on this in a consistent way globally. And so we can help try and move that forward ahead of COP26. I think, just picking up some of the points on taxonomy, as a member of HLEG, this was something I thought was very important. We've been developing our own kind of taxonomy. We have a system called Green Revenues, which we launched back in 2008, was the original classification system, oversight from different investors and technical specialists helping us develop definitions for sectors and subsectors. But the challenge has been disclosure. Companies not breaking out the level of revenues associated with green products and services. We need them to break that information out at a segmental level or a subsegmental level. And so particularly keen about the taxonomy as a mechanism to encourage better reporting, because this is a big gap where investors are wanting to allocate more of their portfolios to green industries, but we don't have good information on that. And we and others are then having to estimate it in the absence of good quality data. So really support taxonomy work. Again, though, it does need to be, as we see taxonomies in other markets develop, but we've got to have consistency between those. They don't need to be exactly the same, but they do need to be interoperable. They need to fit together, so we've got some commonality between it. I've spoken for a while already. I was going to talk a little bit about climate benchmarks, but I don't want to go on talk for too long. Do you want me to speak about that now, or shall I hold off, Victor?
No, if you can give us your core messages on that and what you're seeing in the market, I think that would be a benefit to everyone. What's the uptake in the market from your perspective?
This is, I think, really important, because this is passive investing represents a big chunk of global institutional investment today, and this is shifting. So, as I said, new mandates is often incorporating climate. The methodologies have been evolving over time. When we started off doing them some years ago, they were quite simple. Now that increasingly comprehensive, this is also a big area of market competition between FTSE Russell and the other big index providers, because this is an area where mandates are switching and moving between players. So this is an area where there's a lot of innovation and focus. There is a question which I've been thinking more and more about, which is, what is the real impact of this? Just because many investors are starting to reallocate, overweighting companies which are better on climate issues, underweighting companies which are less good on climate. What is the real world impact of that? Because obviously a lot of this is secondary markets. How much has to shift before it affects cost of capital? And so you've also got these other initiatives which are investors engaging with companies. You've got probably the biggest one is Climate Action 100 Plus. The other biggie is TPI, the Transition Pathway Initiative, which forms part of Climate Action 100. Very powerful initiatives. Institutional investors coming together globally, 50 trillion in assets behind CA 100 Plus, and then collectively saying to companies, we need you to improve on climate, and being joined up on engagement. However, companies are saying, well, on one hand, we get kind of people engaging us on ESG or climate, but then we have a separate discussion with the portfolio managers. Now, the potential with climate indexes is that those things come together. And so one of the things we're trying to do is use the TPI, Transition Pathway Initiative data, which feeds into CA 100 Plus, as the measures for for the management strategies, the measuring the management strategies of companies on climate. So TPI has companies going on kind of 0 to 5 on these different steps, depending on how good their climate strategies are. We're using that to weight the companies in the portfolio. So as the companies do what they're asked to by investors and step up, their weight in the indexes and the associated funds go up too. So you join up investment and engagement, which I think becomes so powerful. They also have an assessment looking at whether or not companies' future targets are aligned with 2 degrees or 1.5 degrees. And so again, by rather than just by plugging that then directly into the index, where the company's weight in the index goes up and down based on that, and being very visible and transparent to the company so they can understand it, and it being linked with engagement, I think can really start to unleash a lot more power and influence from that engagement and the investment.
Thank you very much, David, for those thoughts. Actually, one thing that struck me with what you just said was the disclosure of taxonomy alignment by issuing companies on markets. I believe there's an important consultation by the European Securities Markets Authority closing tomorrow on that very same topic, and these are material information of use to investors. And I think it's interesting, it would facilitate for investors to have that in one place. And maybe if I can turn to you, Tanya, obviously in September this year, the Commission launched a new action plan on the Capital Markets Union. And I believe one of the most important, of maybe even the first kind of policy action in that plan was the creation of a centralized database in Europe, making that data more easily available to market participants. Maybe can you shed a bit of light on the Commission's plan here for the benefits of all the people present?
Absolutely, my pleasure. Just maybe to correct you, Victor, if I may, the idea is not necessarily to set up a centralized database. So what we have in mind is rather to have a single access point. And two things are not necessarily the same. Because I think what is important is to know what we already have, and what we already have, I think, under the Transparency Directive, is the need for publicly listed companies to already disclose quite a bit of data, soon in line with it. Or the digital standards that the Transparency Directive in principle put in place, but there were some teething issues, I think, with companies trying to implement this. But if infrastructure is already there, there are also officially appointed mechanisms that Transparency Directive requires member states to set up so that these companies can publicly disclose data. So it's important not to reinvent the wheel when the wheel has already been invented. So that's the important part. Now, as regards what is behind this objective, what is behind this objective is basically the old story or complaint that we hear often, that investors across different member states do not have access to company data. And it refers to financial company data, but increasingly it starts referring to also ESG data, because as we have been discussing now for some time, investors start getting increasingly interested in ESG parameters of these companies. So as we know, in Europe, we have 27 different markets. Not always these markets are extremely well connected. And when it comes to investment pattern, we still see a quite pronounced home bias. So investors only invest in companies they know best. And typically that means investing close to home. This is the pattern that we would like to break, because it goes against the objectives of the Capital Markets Union, whereby we want any company to get access to any investment opportunity or any investor based in any member state across the EU. So that's the underlying principle, if you wish, of this union. And this is something which is very difficult because investors simply don't have access to information. Of course, this is also related to certain issues regarding accounting practices. So, of course, for big companies, we have IFRS standards, which are difficult to comply with, but they have the benefit of making data comparable. For smaller companies who do not apply for us, they do apply national gaps, and national gaps do differ. So the way the information is being disclosed is of course still fairly different. But as a first step, the idea is really to set up this one access point whereby an investor from any member state could access company data. And in the first stage, we will focus on companies that are already listed and that already have a lot of data available, and then progressively potentially increase the scope. And also, make this data digitally searchable, comparable, in a digital format. And that this is very important because a lot of this data is simply not digitally searchable and not comparable. And that comes also as a very important point when we're discussing ESG, because ultimately, investors might be interested in investment based on the degree or shade of green, and how can you compare green data if you're comparing companies from different member states? So this is basically the premise for this idea to develop something which would enable investor, based anywhere in the EU, to have access to any publicly listed company, financial, non-financial data in order to inform decision. It should support liquidity in products, in investment. It should also potentially implicitly address other barriers that we have to cross-border investment, because sometimes it creates also the right dynamics and creates positive externalities around it. That's the best.
Okay, thank you very much. Thank you very much for that great explanation and for correcting me, the precision. I think I just would like to open the floor now for Q&A. I think we've got a question from KBC.
Yes, can you hear me?
Yes, we can hear you well.
Okay. I have a very practical question indeed. Green buildings are the leading use of proceeds for banks' green bond programs. These programs are mostly based on the taxonomy as it was supposed to be aligned to the expectations set by the technical expert group. Now, when we look at the delegated acts, we see a quite different picture, because the delegated acts go against the recommendations of the tech group. And it leaves us with the question, so how can we maintain the green bond program when the assets in this green bond program are all of a sudden no longer green because of the delegated acts? So that does, in my view, for all those buildings which has been constructed before the 31st of December 2020, this really causes a problem. So how do we have to cope with this, just pure practically? And does this not constitute a barrier for future green bond programs? That's my question. Thank you.
Thank you very much. Does anyone want to take that one and provide an answer?
I guess the question is for me.
Tanya,
Coming from the commission.
I would assume it is for the commission representative indeed.
Right. Now, Chris, I hear what you're saying. TAC informed a lot of what the commission was doing. The TAC was an expert group, a consultative group that the commission used in order to feed into its work. Obviously, it's the commission responsibility to assess the input of any expert group critically. And there were some departures on buildings, but not only. You will probably see this in the Delegated Act, where we believed that in terms of policy, we wanted to be slightly more ambitious than the TAC has chosen to be. And this translated in some deviations in the Delegated Act. I understand your frustration, but I think we shouldn't forget what the primary objective is. The primary objective is really to support and call green, because that's the underlying objective is to make sure that only truly green stuff is called green. That this objective is being respected. And yes, in the past, there's been a lot of, I think, and we still have a lot of assets which are labeled as green, which might not in reality be as green as we would like them to be. And this is the tough reality, I think, for a lot of, operators in the market. And I understand your frustration and the difficulty that it puts you in. Because precisely these are the assets that you thought could benefit from green bond issuances and that are no longer eligible. So I think the way forward for us is to see, you know, what adaptations can be made to those buildings and other assets to make sure that they are actually green enough to benefit from the alignment with the taxonomy rules. And then maybe another point, I mean, on the green bond program, you know, the Commission is working on currently on the framework for green bonds. I mean, we're considering different options, of course, there, but I think alignment with taxonomy is going to be fairly important, and you've made this point yourself. So this is all I can say at this point.
It doesn't really solve my problem, but at least it's a fair answer.
Thank you very much, Tanja, for the answer. I think we've got Piebe Teboom from the FIA EPTA also for a question. Piebe?
Thanks, Victor, and thanks also to the panelists for a very good discussion so far. And my question is, well, first of all to Tanja, but also more broadly. So given the ambition of the Commission for an annual investment of 460 billion per year, which is of course a big ambition and a welcome one. What are your thoughts, and also of the others on the panel, of what role secondary markets can play to actually facilitate that the end investors, and especially institutional end investors and pension funds, are able to play that role, given that they have a continuous need for liquidity, given that they have mandates that need to be changed or liquidated if you have inflows and outflows of funds, and you have requirements to do payouts, for example, to your pension participants. Also, of course, given the fact that we have a market operator and a liquidity provider on the panel, would be interested to also bring light on that aspect of the role of secondary markets, liquidity, and also of risk management when you have such large exposures on your books. Thanks.
So I think, Tanja, the question was addressed to you, but I also, you know, of course, if other panelists have thoughts here, you know.
I'm happy to have a different voice on the call. I'm happy to kick off. Thanks for the questions, Peter. I mean, you know, Peter, from a market making point of view, you know, and the beauty is that I think all of you use the words deep and liquid markets so far. You know, those are words used a lot by market makers. I think the secondary market ultimately is where all the action takes place. If you have a strong secondary market, the primary market will remain strong as well. And as I said earlier, I think that means keep things simple, try to standardize as much as possible in the beginning, make it transparent, have good regulation around the product, around the venues where you trade, and also the structuring of the product, so there are no questions being asked in the future. And I think that will create the confidence, and everything else will follow. But you know, I'm interested also to hear from Caroline, for being a politician, how you see that, right? Because this is, you know, as we said earlier, a global drive. People want to do this, but from a politician point of view, I'm just wondering how you see that.
Yes, thank you. And yeah, well, first of all, when you, and I think in the previous round, Tanja explained it very well about the CMU plan. And I think the first and top one part of the CMU plan is that we should ensure the EU's economy recovery, that it will be green, that it will be digital, that it will be inclusive and resilient. And when related to the question of Piebe, I think it's very relevant that you mentioned this, especially this pension part. And that's the way when the ban comes up, the European Parliament encouraged also the actions to promote the more funded pension system as a, let's just say as a way of to deepen the pools of the European capital available, especially for the long-term term investment. So I think, especially when you look to pension funds, these are investors with a very long-term perspective and interested also in a sustainable finance product. So when you look also to the role of the European Parliament and, well, let's say my role as well, is that we should work, and maybe it's more general, but we should work in favor of the regulatory harmonization and also the international standards. I think that should be relevant because that can bring, and then I come back to the point also of data, that can bring also better data quality, better availability, and that would, in my personal opinion, be the most important aspect also of the ESG products to become much more mainstream.
Yeah, and maybe Victor, if I want to add one thing.
Sure,
right?
sure.
Caroline, I think you over the years have done a lot of work on, for example, creating a market, a secondary market for small and medium enterprises, to really support entrepreneurship. And I think the difficulty there was there was a primary market but no secondary market. And I think that's a lesson learned, and that lesson we really want to apply in this space. And I think therefore people, a strong secondary market will support a primary market, not the other way around.
Maybe I could.
David, do you want to come in and comment?
Yeah. So what's needing to happen here, and is increasingly happening, is institutional investors are looking at how they can integrate this across total portfolio. So this is about, yes, public equity, but it's also about private equity. It's about fixed income and what to do with their bond portfolios. It's what to do with their real estate, we heard earlier on. It's what to do with maybe kind of real infrastructure investments as well. So it's across all of those pieces, which is also back, and then I think there's really three different pieces to this, which we've kind of touched in various ways today. One is about disclosure, and I've been talking about how important it is to be joined up. It's also important to be joined up across asset classes as well. So you need to get the data right, the data and disclosure right. You need to get supporting the green economy pieces. And so this is about talking to Caroline when she was talking about kind of financing green and greening finance. So you've got the second bit is effectively the financing green bit. So, and the taxonomy speaks to that. And I think it's very helpful to be able to clearly define kind of green activities, green revenue, etc., and do that in a cross asset class way. The third thing is transition, and how do you support the whole marketplace transition, which I guess is a bit like the greening finance. And so you need all three of those parts to work. And so what I don't think is helpful is if you think about this as some kind of something separate, this is some kind of capital markets over here, and you've got kind of sustainable finance, so which is somehow separate to that, and therefore is going to create liquidity issues or is going to be very non-diversified. It's got to be all of those things. Is that a fair answer?
I believe it is. But Tanya, I think you share your perspective, please.
So it's very comfortable to come in last, because like that I can build on what has already been said. I think David actually said what I was going to say, because I think we need to also look at the types of products and instruments and the variety of those instruments, because I think what is important is to ensure that companies can support their green transition with all the instruments that they find suitable. And this is what the CMU is about, making sure that every company can finance itself. Bank lending is not good for everyone, so you need capital markets. And I think we need to draw a line between fixed income products and equity. And speaking of fixed income products, it did remind me of the discussion we had several years ago about the lack of liquidity secondary market liquidity for corporate bonds. And we try to kind of, put our hands together and try to come up with a perfect solution. How can we support the secondary trading in corporate bonds? And the solution was not found, to be honest, because I don't think actually there was a need to look for a solution, because ultimately this is not how the market worked, because the market companies were relying on something which was by definition fairly heterogeneous. So corporate bond is very heterogeneous, it's very different from equity. And many investors, including institutional investors, were investing in order to hold, not in order to trade, but to hold to maturity. So we were, in a way, in my view, we're trying to fix something that wasn't broken. So I think maybe something that I would like to say to Pim here is, let's not try to overcomplicate this. I think as long as companies can issue instruments that can support and underpin their green transition, as long as primary markets are flourishing, I think it's already a long way towards ensuring that funding is going in the right direction. I understand that David is in secondary liquidity, and so is Jan, because those are intermediaries. They're very active in secondary markets, and they have an important role to play for those instruments that need to be regularly traded. And I think equity is fairly different from fixed income in that sense. And I think we need active and very liquid and deep, secondary markets for equity. And that's why I think the role of liquidity providers or market makers like Optiver is going to be paramount. But we should not forget about the primary, reason behind all of this. So the reason is really to make sure that companies can finance their transition. And as long as they can do this, whether the market is not always as liquid as we would like it to be in every single product, I think it becomes a bit secondary. Sorry for the jeu de mots.
Could I just comment, maybe Tanya, on
Definitely.
which is, so I think it's been fantastic to see the growth of green bonds and sustainability bonds, and that broadening out, and the concept of use of proceeds, I think, is very powerful in terms of being sure that actually your financing is moving. But investors need information across all of their fixed income. So it isn't just that. They do need it across the rest of their fixed income portfolios, and they need to better join it up with what they're doing on equities. If they're underweighting a particular company because of climate risk on its equity side, but they're going long on its long-dated bonds, there's something fundamentally wrong. This has got to be joined up between the different sides. Equally on private equity, when we see disclosure regulations, we need to see them on private equity as well as on public equity, because they'll be holding both portfolios. We need consistent information. So I think it speaks to that. Yeah, we need to get both bits right.
Okay, thank you. Thank you very much for those fantastic answers to a good question. So thanks, Pibe. I think we're getting another question from ABN AMRO. I think the technique is the person from ABN AMRO able to switch on their camera and audio? Yes, I think we have Pauline Engelberts there.
Hi. Okay, sorry for that. Yes, thank you very much for this. I work for ABN AMRO Clearing, and I have a question directed to Caroline. Actually, we've talked about the whole infrastructure, the financial markets infrastructure, and clearing also plays a very integral part in that. But what role do you think clearing can play in the green transition? And are you envisaging, or do you think there are any prudential roles that should be applied with regards to clearing, which could also assist in the green transition?
Caroline?
Yes, thank you, Pauline. Well, maybe first of all about the clearing members and the role they can play. Well, first of all, they can include, in my opinion, the ESG elements, diversity, sustainability, also in client onboarding, in portfolio assessment. So I think that they really could play a role in that way. More regarding your prudential questions for clearing members. Well, let's say maybe it's not my task, or maybe not I'm in the position to, let's say, judge on the specific capital requirements rules, but I can give you an answer more general and more maybe also from a liberal perspective, because I don't think that the capital requirements are the best instruments to steer the investments towards ESG products, because I believe that credit risk should be the one and only driver of capital requirements, and green investments do not necessarily reflect a lower risk, in my opinion. My previous job was in the Port of Rotterdam, so the discussions we have nowadays about green investments, well, I have huge of discussion with my friends from the left, so to say, because I found an investment to make a coal plant more green and more sustainable. I find that a green investment. Nuclear energy, I think it's a green investment. So to say, I think we should not keep that as a driver of capital requirements, because it's quite subjective in my way. So green investments do not necessarily, well, that's what I said, reflected the lower credit risk. But I think that what's more important is, and that's what I mentioned before, is that the whole way of transparency and the harmonization part, that can be even more effective than changing all the prudential requirements nowadays. So, well, I said I will not judge, but I think it's more than as an answer and maybe also a judgment. So thank you.
Thank you.
Thank you,
Not sure, Pauline, I'm allowed to answer your question, but I do want to take this opportunity. I was a bit disappointed you didn't address the question to me. I'm joking, but no, I think, ABN clearing being, one of the dominant global outfits when it comes to clearing, I think going back to our previous topic, I think clearing the non-equity products, I'm talking about bonds, that would be a major game changer for the industry. Now, we all talk about bonds, and the reality is there's no real secondary market in bonds. It's a over-the-counter, by appointment only, bilateral business. And I think, as David said, and I think Tanya referred to as well, that has to change. You, as one of the dominant clearers, can play a big role in that.
Okay, thank you.
Thank you, Jan. David, Tanya, want to comment? Don't have to if you don't.
On HLIG, we had a lot of debates about some of the prudential and just what, in terms of what recommendations we wanted to give them, and we were cautious on this, I think, for the reasons that Caroline set out, in that there is expectations of high growth from green activities and green sectors, but there is a lot of volatility there as well. We're seeing massive innovation, huge change in many of these sectors, whether that's in renewables, whether that's in advanced batteries, whether that's in lighting, so really exciting investment areas. And as an investor, you want to be probably overweight in these areas. But is it, from a risk perspective, we were more, pretty hesitant in giving any recommendations on that.
Good. Agree.
Okay. I'm realizing we're getting close to the allotted time for this panel. So I would like to do one final quick round of a wrap up and ask each panelist, what do they see as the critical issue in ensuring capital markets are, making their contribution to the green transition. So maybe if I can start off with you, David.
I think it's enabling the marketplace. It's enabling asset owners to be able to shift their investments in the way they want to be able to drive this. And I think that many are really wanting to have impact, drive change, and get the fact that they actually have a kind of a macro view because they're invested across the whole economy. So they're interested in the whole economy shifting. And I think many are now realizing that this kind of concept of being a universal investor. On the other side, also then helping the users of capital, the issuers, in terms of being able to raise capital to be able for really big long-term strategic issues, which often are very highly sustainability linked, and how to join those two sides up effectively.
Okay, thank you very much. Jan, final thoughts from your side?
Yeah, I would say let's keep it as simple as possible at this stage. Let's make sure that people appreciate what the products stand for. Let's make sure they're available to everybody anywhere in the world. That means on lit exchanges, and maybe also provide some incentives for those involved in the whole process, like we do in many other areas, to stimulate new initiatives and new products.
Okay, well, wonderful, thank you. Tanya, if I can turn to you for final thoughts from the Commission side.
Okay, well, since I'm the head of the CMU unit, I think if we can make quicker progress on CMU objectives, that would only help green objectives. So let's use CMU for achieving on green, and let's green to achieve on CMU, because there are synergies to be made.
Okay, thank you very much. And Caroline, final thoughts from your side.
Yes, thank you. Well, when we look to addressing climate change, I think it's obviously not something that happens overnight. So we need a very long-term horizon. So I think, and it sounds so cliche in a way, but the way we should work together as policymakers to help to improve our harmonization, but also the commitment of the market infra providers. I think together we can make this shift towards the sustainable and ESG investment.
Okay, thank you very much. Well, I think, thank you very much to all our panelists for the fantastic contribution today and the great discussion. I think it was very good, lively, and I hope it provided a lot of useful input and answers to the audience. I'm sure they would be giving you a virtual round of applause if it was possible, but rests to me to thank you all for your great contribution and to wish you a good rest of the week.